Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your Cannabis Business Podcast. Today we've got Emily Paxhia and Morgan Paxhia. They're both the co-founders of Poseidon Asset Management. Guys, thanks for being on Talking Hedge.
Thanks for having us.
So for those who haven't heard of Poseidon Asset Management, you guys have been around for a long time. I've been following you since 2015, before Brandon of Investing in Cannabis picked you guys up, and that video has been seen like 5,000 times or something. But for those who haven't seen the video, who haven't heard of you, what is Poseidon Asset Management?
Go ahead, Morgan.
Sure. Poseidon was founded back in 2013 by Emily and I. We're brother-sister team. And, we basically saw an opportunity to start, bringing a true institutional approach to investing in cannabis. At the time, there wasn't anything like that as far as bringing, true portfolio level minded investing. And, there were some early kind of incubated ideas, which are great, but we just thought it was a differentiated approach. And, bringing a fund to the industry, very diversified, initially broadly diversified across the industry. Just thought it was a unique opportunity and something that we're very passionate about from a social justice perspective, as far as moving legalization forward and trying to help shape the industry in a positive direction, being kind of the first ones in the market, bringing capital to the market. We've always believed that capital can be a positive change agent, and having a chance to do that out the gate, we thought would be very valuable long term, not only for our investors but for shaping what would be a multi-billion-dollar global industry.
Now, Emily, you came, correct me if I'm wrong, but did you come from the East Coast to the San Francisco area, and then you went to like a medical dispensary and you saw some products and you're like, okay, this is something to invest in? Like, what inspired you and how did that happen?
So there were kind of two moments that really drove getting into this space. The first was, I remember riding in a car across the Golden Gate Bridge, and I was looking at the SF gate, and there were advertisements for cannabis dispensaries and cannabis product companies. And I was like, this is crazy. After living in Boston and New York for about 10 years before that, just coming to the West Coast and seeing that not only is it legal in California, which it was very gray regulations at that time, but but the fact that these companies could be advertising. And I'll say that the advertisements I saw, coming from my background of consulting with consumer product companies, fashion brands, finance companies, just saw a lot of room for improvement. And so whenever there's room for improvement, there's opportunity to participate and drive growth. So then I just, started to pay more attention to what was going on in San Francisco. And you have stores like Spark and Apothecarium, and they do not look like what you would anticipate maybe some of the, old fly-by-night operations would look like. These were real retail operations. They looked like boutique hotels or high-end retail experiences. And so it was clear that they were really building a brand around quality and product assortment. But yet, if you go into one of these dispensaries back in 2014, you're having this beautiful retail experience, and then you're able to look at a brownie that's in a plastic bag with a business card stapled to it, and that was like a consumer product. So, and that at the point of sale, they were doing the ledger on pencil and paper. And, it's just like, and those are the cues and clues that really indicate that there's a ton of opportunity to look at ways to invest along the entire cannabis supply chain. And that's how Morgan and I started talking about this. I actually was walking down Ashbury. I live up in the Upper Haight area in San Francisco. And I was walking down Ashbury Street on the phone with Morgan, and we were talking about how we thought this could be the opportunity of a generation.
Well, good call, because it is. One of my favorite investments that you guys have made have been Headset. So I've known Cy Scott since he was at Leafly, and he was doing the cannabis tech in Seattle early on. And the data analytics out of that is phenomenal. So easily one of my favorite companies, and easily one of my favorite, companies that you've invested in. But what is your favorite? What is something that either comes to mind that you really like, or that is maybe even your favorite investment that you've made so far? And then we'll kind of get into what you guys are going to be investing in.
I mean, I just want to kind of tie the line through on Headset too, because I think that Headset is really getting traction in the product company space and the retail space in cannabis, because the real-time data and the way that they present the data really can drive business decisions. And it's been incredibly necessary during the vape hysteria that happened last fall or 2 falls ago. And then also through the pandemic, understanding what was really driving through this massive shift in consumer behavior around cannabis. So I just can't say enough. But for the investor audience, I think it's something that has not necessarily been picked up enough yet. And I can just say that our whole team is on the Headset dashboard all day. And obviously, I'm talking my book. I love the company, but I think from an investor landscape, as people, I mean, it's clear people are paying more and more attention to this industry, and I think that savvy investors always use information as their edge, and data is absolutely a driver of that information edge. So anyway, Morgan, do you want to talk about one of your? We don't have favorites. We say we don't have favorites, but we'll talk about, they're all special to
Yeah,
us.
which one comes to mind then for its uniqueness or specialty?
Well, I'll check off a unique one. One we're actively working with right now to close a round of financing is industrial hemp processing company called Basscore. It is, innovating in the, primarily or initially into the textile industry. So this doesn't have anything to do with THC. This is on the industrial hemp. This isn't CBD. This is, again, industrial hemp, which is very unique. This is something that's very, very new, up and coming technology that can, potentially penetrate multi-trillion-dollar end markets, and textiles is one of them. And so for us, couldn't be more differentiated from cannabis, which we love and we obviously work in all day, every day. But it's just so interesting to be a part of something that is still genetically, ties back to the same origins, but couldn't be more different. And things for clothing, some of the partnerships they're working with, and they're just about to enter commercialization, starting to sell their fiber to end consumers that can make things like denim. For us, I think that is just truly a differentiated investment that most people aren't talking about. As Emily mentioned, I think we're at Poseidon, we have kind of a history at this point of being at the front edge of the curve and thinking about where things are heading and trying to position with really great people ahead of that. And Basscore is one of those. I mean, we've been working with this company since 2016 in an R&D stage. So a lot of development, a lot of IP creation, lots of sampling with partners around the world at this point to validate the quality of their product. So it's really exciting to see it coming to this point. And you're in states that are moving towards opening up cannabis as well, because the company is based in Alabama. And if you would have seen earlier this week, their Senate just voted to legalize medical, which, remember who was the former Attorney General of the United States and where that person came from, and now seeing medical heading to legalization in that state. But they started with industrial hemp. And so, as they get more comfortable in understanding what this plant means in its various forms, we do see that as making positive progress. And if we can do that from an ESG standpoint and just furthering the betterment of society, and for us, that's just very exciting and again, very differentiated.
It's good call. I want to kind of ask you a question about some predictions that we had, or not predictions, I guess. Let me pull this up here. So some of the investing trends, I guess, that we kind of saw in 2019. So I kind of want to take a look in the rear view before we move forward with investing. And I kind of want to see your thoughts on how things went pre-pandemic and then where things are going to be going afterwards. So in 2019, we saw a lot of multi-state operators with the top investing trends, moving into 2019. Along with data, we mentioned Headset and the importance of that. Consumption lounges, totally derailed by the pandemic and sidelined. with some honorable mentions, like you mentioned, Emily, that whole vape crisis that we saw. Then there was accurate dosing, and then beverages, which we've seen, billions of dollars being written off up north in Canada.
Mhm.
So with this list, you guys see anything from 2019 that you either wish you had invested in or wish you hadn't? With the way things have moved post-COVID, I kind of want to, or post-pandemic, want to talk about before that, with all of these investment trends. Where did you invest back then, and what do you feel like you missed out on?
The one thing so we didn't invest into consumption lounges. To me, that's kind of a confluence of restaurant, hospitality, and cannabis. And there's a high failure rate in the restaurant space. So you have to be really thoughtful about how you approach it. I think if a retail operator has it as a part of a piece of their full vertical and an additional offering for more brand exposure, I think that's something to think about. And one of our operators does have that piece to it, but it is built into the entire infrastructure. So you're not kind of betting on that one piece. I think that's a little bit different for us. And we think that, and they were one of the first to have a consumption lounge back in the day. So they've just got the history of having done it successfully and have done it well in the eyes of the regulators. So, the one place that wasn't listed in there that we have invested into is more just along the entire software aspect of the industry, which as these operators, as the MSOs continue to expand their operations, there's not a lot of efficiencies that can be achieved across state lines due to like packaging considerations, labeling considerations. You have to have your vertical within each state. So there's challenges to get those efficiencies of scale. But one thing you can achieve that with is in software. And then your software, if you can have that pulling into centralized hubs, you can really have a full operational view of how you're running across all of your different regions and markets. We've been very cautious to endeavor into branded products, and that does include beverage. And that does have to do a little bit or a lot to do with our access to data and the way we look at what's in the levers that are being pushed and pulled and driving growth on that. And also just our background in understanding, when you consult with PepsiCo, when you look at how these companies build brands, you understand the magnitude of capital that is required and the time. And so we have to be very cognizant of our timeline to exit because we have specific strategies with specific timelines. And we also try to figure out how to allocate our capital the most efficiently. And it's our opinion that we're going to see a few waves of brand development, and we have not yet seen the brands that are necessarily here to stay forever and ever. I think we have a couple of front runners. You might see like Awana, Akiva, some of those brands emerging, but they're going to have to fight hard to keep that position because there's a lot of people coming for their lunch. So, and I think they are well positioned to do it, but it's tough for the branded product world. And then just on the beverage space, again, it comes down to our data. You can see that you can do different pricing strategies. You can drive the price, offer major discounts. It's not moving a ton of product. And as Morgan always notes, we track inventory levels across the states, and you can see where these things are building up. And so we're just kind of slower to allocate in those spaces where we think there's still a lot of work to be done. And we think we can still get in at early entry points, but we think we don't have to go through the really early rocky trajectory potentially. Although I will say it seems like it's starting to get to the point where we would look at it with a specific, maybe early stage strategy. But I don't know, Morgan, do you feel like we've missed out? Maybe we could have leaned in on some of the smaller MSOs a little bit more over the last year.
Yeah, I mean, we have to, very cognizant of our ROI and, opportunity costs. And, we felt a better play instead of the smaller MSOs was to go deeper with single state operators. And so, and I feel very good about that decision. I think that's becoming very attractive. This year, it could be a very robust year from an M&A, just M&A alone. I mean, but you're looking at just a lot of capital activity picking up in our space, and scale is showing value. And some of the Gen 1 MSOs that have really struggled and had to liquidate assets or, blew up their cap structures, and, their common stock is worthless or near worthless because of just bad management, bad capital allocation. There's some very good MSOs in the early days that have emerged, and they're the ones that are in a very great position for consolidation. But we think in that single state vertical, if you go deep, there's always the mantra of an inch wide or an inch deep and a mile wide. Were some of those Gen 1 MSOs, and so you saw some of the better managed teams kind of held back on the inch deep and started going deeper within markets that they had already won licenses in. And now as they're getting those scaled up, they're looking for additional growth in new markets. And when they're looking for those companies, they want to see good fundamentals. And if you're doing a good job staying focused in a single state, your fundamentals can look very good. Your gross margins, your EBITDA margins, in these competitive markets, not necessarily limited to the limited license markets that are more common on the East Coast. So that's just there's different timelines. There definitely was a reflation trade that lifted a lot of boats in the public markets, and so that certainly helped some of the smaller operators get as we kind of call it, one last puff in the sails. But we think the great thing about investing private side is there's more time where you're not held to every single quarter for demonstrating every single metric is peeled back and looked at. There's a little more gestation period, and then those can be very interesting potential exit strategies for those companies to become a part of a more efficient, larger ecosystem. And so that's for the single state, I think that was a great it's just a differentiator from a time perspective, and we have good relationships with public companies to kind of talk about that too when they're looking at expansion efforts. Where could we potentially be helpful, and what are we looking at, since we do have so much focus in certain areas.
So when you go in and you invest in a company, when does the exit strategy come into play? Is that something that you guys talk about right off the bat, what the exit strategy is, or what is the entire philosophy and process of your investment strategy and implementation?
Yeah, I mean, we're never one of the groups that's like, let's rush this to SPAC, let's rush this to exit. We're all about building to maximum potential for that exit timeline to get the best return possible. But we have timelines that we have to contemplate for our fund strategies, So it is one of the early conversations that we do have with the founders, because we've found it's critical to have alignment. That's one of the things we've always tried to do as investors is we view ourselves as really the partners of the companies, not just kind of at hands top-down investor mentality. We like to come alongside them. And so the best outcomes have always come from when the founders view us as that partner level. And if we're all aligned in the beginning, things change. But if you have an understanding, at least you can talk about it when it does change and navigate that together, and then there are no surprises. So timelines do, contract and expand. Like I would say we're going to probably see an exit in 2021 that I didn't think would happen as fast as it's happening. Just one to come to mind. Actually, we just had another one that were happening, and I didn't think that one would be happening for another year or so. So things are, they expand and contract, and you have to be nimble, but it's good to have established a baseline understanding so that you don't have any misunderstandings around the objectives. I think some investors get into companies and then realize that the founder was thinking, oh, I'm going to have this is my life's mission, I'm going to have this company forever, and hasn't contemplated how to get the money back to the investor. And so that's where alignment comes into play. And it's also helpful for us in terms of structuring how we enter into an investment. And so we've done everything along the entire capital spectrum, really, from straight preferred equity all the way through to convertible notes, all the way through to straight debt. So we're very open to thinking about how those different structures work. And I'd say that served us well too. There have been a couple of investments Morgan and I were reflecting on where people were just in the equity side and we were in the debt side, and we got our, principal plus about 20% out of those companies. And now one of them is basically about to fail. And so the entire equity stack is just in the Hurt Locker, but we actually achieved a 20% return on that investment in 3 years. So pretty happy with how we've thought about all those things. It's helped us to sidestep a lot of the early froth and subsequent wipeouts that we've seen in the space.
So, Morgan, do you think it's possible to have a legacy this early in the game? Emily mentioned that the brands aren't quite there yet, and I totally agree. And I think that's somewhat controversial, actually. I think people believe that there are like these brands, and there's really not yet. But I've always said that you need an exit strategy because you don't want to be a Larry's Handy Mart in a world of 7-Elevens. The mom and pops, whether you look at microbrews or individual coffee companies, those industries have kind of showed us that there's going to be the corporate before kind of the companies that you want to consume. The discerning flavors and the strains and flavor profiles that you want. All of that stuff is maybe years out. I think Burner's doing a decent job with some genetics. But back to my question with you, Morgan, sorry. Do you think brands are going to be, when are brands going to be a thing? And is it too early to have a legacy in this industry?
I think it is. I mean, we're still just learning about form factors. We're still learning about consumer preferences, which are still changing because consumers are, frankly, are kind of the industry guinea pig of checking new things out. I mean, I think a great example was, early on in the edible space, it was chocolates. And then all of a sudden gummies just took the industry by storm. I mean, that was just impressive to watch. And then you saw, and then brands within that, all of a sudden shot up that came from nowhere. Same thing, like just take a simple joint, that was kind of a very simple product, a pre-roll. And now you're seeing a lot of innovation in that category. Now there's a lot of growth with some new differentiated products, infused products that, make a joint a lot more enjoyable than, just kind of what was a very other, historically had been a low priced product you just kind of grabbed at checkout. So, there's just so much to be developed. And I think, where there could be some developing brand legacy are those that, stay nimble and try things and try to, not be too stuck in a certain channel. And as Emily and I always talk about, you have to be dynamic. This is just so early. And so brands that can navigate through these early years and showing new products that consumers might be attracted to. But, to be able to do that, they need the infrastructure. And most of them are just not there yet. That's why multi-state operators are doing a good job of, creating some consumer stickiness potentially, because in a lot of instances, they are literally the only game in town. If that's the way the license works, that might be your only store. And so you might only get so many choices, but they also have the back end infrastructure, right? They control the grow, the processing, the manufacturing, however, what products they're creating. But that's why we think California and Oregon are very interesting markets, because it's more of an open market, and so it allows for innovation and creativity, and really fun brands. Like I think Oregon has some of the coolest brand development. I think California has a lot of innovative product development. So between the two, it's just really interesting markets to be in. But we have a long time. I mean, just even touching on beverages, it does seem like some are getting some traction, but it's a long way to go. There's structural challenges with logistics and distribution that, make that industry really hard or that subsegment to get a lot of traction. There's also technological developments around onset, offset that still aren't there. There's a lot of claims around it, but we're seeing not much differentiation in that space. So there's some good attempts at branding to try to separate, at least in the early days. So we'll see. But for us, it's more focused on fundamentals and nuts and bolts and building proper infrastructure for an industry that's, where were we last year? 15 billion or so, heading to 50 billion. That's a lot of infrastructure. That's a lot of development. It's a lot of jobs. It's a lot of capital. Don't put the cart before the horse, and just stay focused on good quality people that are building.
I saw a meme that had a guy in a Spider-Man costume, and it said, "With great powers comes great responsibility." And so I kind of think of that with first mover advantages as well. You have a lot of power and a lot of responsibility. And so yet with first mover advantages, we've seen some liabilities. So with delivery, there's a certain delivery company, I'll just say their name, Ease. There's $35 million and they haven't been able to do anything with that. I think the pandemic served for a really good opportunity and yet it failed. And so you've got other valuations with Weed Maps, $420 million valuation. That is crazy and just waiting for that price to dip a little bit after they go public and create some shareholder lawsuits. So how do you avoid getting into scenarios that fail and or are liabilities with certain lawsuits?
I mean, we have a really rigorous due diligence process, and it's long and it's deep. And I mean, we do the best we can in this industry right now. There are a lot of lawsuits going on, and I would actually say that some of them I think are just frivolous and spiteful lawsuits because people feel like they missed out on something. And frankly, because unfortunately, we live in a really litigious society, and so you can sue anybody for anything, and it's just you have to deal with it. And so, back in the day, when I was getting into this, someone told me, you haven't made it until you've been sued. And so it's like, I mean, or on the periphery of a company being sued as an investor, like, so, that's like something you just experience in this industry at this time. But the way that we've avoided it way more than I think a lot of other people is just through due diligence and through selection of management teams and prudent capital allocation. It's been, I'd say, our driving force through this whole thing. And for a while, we felt like we were losing our minds. Like back when we saw some of these IPOs at $1 billion, $1.5 billion, and they didn't even really have the assets that they said they had. Everything was cross-collateralized. The management teams did not have alignment in terms of their compensation structure. They had these crazy success bonuses for IPOing, not even for anyway, there are so many things that were completely misaligned and we just wouldn't touch those things. And for a while we felt like, we were hearing from a lot of people that they thought like, oh, why didn't you guys do that? Why didn't you do that? And guess what? It totally paid out because we didn't do that. And so we sidestepped all of that washout and we stayed focused on the operators who are really thinking about building strong fundamentals and strong long-term businesses. And a good example of that would be, I think, GTI, we've been investors in them, Morgan points out, since they had 30 people on their team. And they were still kind of that disaggregated MSO back in the day that was coming together. And we just really felt like the management team was focused on being prudent with their resources and allocating wisely and just building. And we've done that time and time again. And to Morgan's point, we did that with the SSOs. And I think it's really how we have managed to get around a lot of the drama that has gone on in the industry and try to stay heads down and really focused on our core strategy. So I think it's benefited us a lot in terms of just continuing to go forward.
And just one other quick thing on that, the commitment to governance.
Yes.
Emily is a professor of governance. Really just a constant pushing to make sure companies are doing things right. And another area that we're constantly pressing on is respect of taxes. And just making, because to your point of liability, like that's a part of this industry that so many did not treat seriously. And it's serious. The worst case outcome is all investors are liable for those taxes. And that is real. And, as companies that have not paid their taxes, if you don't think the IRS is coming, you're fooling yourselves because they know what's going on in this space and they can see who are the good actors and what they're paying. And if you're not paying a commensurate amount, something doesn't add up. And so, that is a big risk that we see coming to this space for those that have cut that corner. And investors are, I don't think, aware that the liability they could be taking on participating in these companies. And that ties into governance as well. So.
Yeah. So, I mean, we're seeing the FDA sending out letters, a lot of letters, and there's so many issues out there about not following compliance. And it's frightening, actually. I think that's going to be a huge issue not paying your taxes is crazy. I'm thinking of two companies, one in Oregon, one in Washington, who were very successful and failed because they didn't pay their employee taxes or sales tax. It's crazy. And then you're going to drive around in a really nice car, and it's just insane. I just don't get it.
You got it. That's right.
It's
real.
Yeah, it's crazy. I want to kind of focus on moving into the future, looking at Cannabis's 2021 predictions. This comes from a small data set that I put together from about a little over a dozen publications, looking at about 70 data points and putting that together. And so all of these publications had said, these are what we think is going to happen in 2021. So I kind of want to look at this from an investment side, highlighting that price and profit was 2020's number one prediction that companies were going to have to get their books in line and focus on price and profit. And now that we're seeing this expansion after October's election or November's election, and all of those states going on board, looks like legal and regulation is kind of that focal point. So I'm curious with, Vermont just flat out saying, yes, we're broke, we need the money. New York seeing FOMO from New Jersey, and Kentucky having the least funded pension plan in the country. I'm looking at those states and staying away from Oklahoma because they have 7,500 licenses and will make Oregon look, like they're just out of cannabis entirely. What are you looking at in terms of regions, and what are you avoiding?
Morgan, do you want to go first?
Sure. Well, I think, you make a really good point in that, we do pay attention to the structure of a market and where it is in its life cycle, because we have invested in Oregon, but we were very patient for when we entered Oregon, because we did see a boom bust setup there happening. And so we just were very patient and kind of let that wave play through. And when you look east of the Mississippi, some of these markets get so hot that the prices just get bid up like crazy. And so it's really hard to get too excited about it and overpaying. So we just, we throttle back and come back to areas that, do not see that. So we're, capital flows are a big part of our analysis as well, and just trying to be cognizant of, so structure of the market, timing of the market, and capital flow, because there's only so many opportunities within a certain time set, and if you're just not being mindful, you'll get on the wrong side of that. I mean, we saw companies pay $50 million for a license in a state with nothing, no assets, no operations, nothing. They subsequently had to write off a vast majority of it. I mean, we've seen a lot of companies just overpay, and some of our companies have been benefactors of paying 10 cents on the dollar for what they had paid for it, and or half off even 12 months later after they paid for it, because we just were being smart and disciplined and following a process. We think California is a very interesting market. It's very difficult, misunderstood. It has structural challenges. So I'm kind of giving you all the rough parts of it. But on the other side of the coin, you have the largest legal market in the world from an adult use perspective, and one that just voted in numerous municipalities in November to open up more adult use access for the first time that previously had no access. And so, the state for the first time feels like there's some visibility into addressing or tackling or penetrating some of the illicit market that is a very large market share still in the state. With some additional potential movements at the state level, could really accelerate things and make this a very robust market. But within the state, it's a huge state, right? I mean, it's the fifth largest economy in the world or something. I don't know where we rank after the pandemic, but a very, very large and geographically large. So within the state of California, you could almost think of it as little multi. It's a collection of states where you even have limited license markets within California. And so if you're smart about what these markets look like, they can have very interesting metrics. But capital has been very, very low here. Valuations as a result are very low. And to us, that just sets up for a very interesting opportunity set. And it takes discipline because there is legacy here. So, going back to our previous point about taxes, you dig into their historicals, and there's a lot of phantom liabilities all of a sudden start showing up, and those follow through to the, who acquires the licenses. So there's a lot of homework to be done, and so it does make M&A challenging. And there's also just, such a wide spread of sophistication. And so, tailoring that it takes a lot of effort. And, we've definitely leaned in with companies here in sorting through that. But ultimately, that trajectory looks really interesting.
So with M&As, when you guys are looking at new opportunities to invest, what are you looking at? Is it the new market entrants, in the East Coast, or these new states that are onboarding like Arizona, Montana, New Jersey, Missouri for medical? Or are you looking at distressed assets on the West Coast? Because some of these predictions that we're looking at, there's consolidation, still the high demand, price and profit, international expansion, investment surges, all of these things that kind of overlap one another to a certain degree. Curious about what you guys are looking at in 2021 and beyond. Is it new markets or distressed assets?
Could it be something in between?
Absolutely. Yeah. What are you guys looking at? Yeah.
I think we are looking at some things in some of the single states from a consolidation standpoint, especially with some of our single state operators who are poised to be the consolidator. And we could be funding some of those endeavors to consolidate further. And so I think what we're looking at is not necessarily distressed, but operators that are just a little bit subscale and are struggling to keep up with the deep vertical aspect of the markets. And so being able to expand footprints with our existing operators, we're leaning in on that for sure. And so we're definitely looking to do that in California. We're investors in this company called Spark. They have a deep vertical of outdoor cultivation, manufacturing, processing, and then retail footprint across Northern California, and now is expanding into Southern California. And so those are the types of things we're doing with that existing fund that we have. We are looking at a couple of opportunities that we feel like are in that software space that we feel are just still gaps that are not serving the market, but those companies are a little bit further along and they're showing that they've got real traction. And then we've identified a couple of operators that we think are doing really well and who could be poised to be acquired very quickly by an MSO who looks to come to California, looks to come to the West Coast and see strong operations, see an accretive addition to their portfolio of assets. So those are the types of things we're looking at there. As we're contemplating the launch of a seed stage fund, since we've noticed that there's a gap in funding in that aspect of the industry again, that's one of the things we always try to do is identify where there's gaps in funding, because that's a great opportunity to play as an investor. And so we've seen some opportunities around that. And we think that, this could be a great way to play in some of the branded products that we're seeing just that really are starting to develop some momentum. So that is a little bit early, but not as early as some of the other things. And then on the East Coast, definitely could look at some early stage operators out there who, again, would probably become poised to be part of a consolidation play in the next couple of years as the operators just deepen their bench out there. So very, very interested in those East Coast markets. Couldn't be more thrilled to see, what Morgan was talking about with like New Jersey, New York, the Eastern Seaboard coming, since we're from there, and also just because seeing the benefit of legalization on the West Coast and these Western states. The states have leaned in and done a lot of studies on the impact of legalization, and it is definitely a net positive. And so I think all of those states on the Eastern Seaboard could benefit from it. And so we're looking forward to playing in that space, and would frankly just love to see, more expanded reach for my friends back in New York and Brooklyn and Boston, being able to access great cannabis instead of having to pay a fortune for a really crummy vape pen at a medical store.
Yeah, well, they will right off the bat. $60 to $80 a gram for concentrate is what California had and Illinois has, and everyone will have. But of course, we always see those prices coming down. Thanks to our friends at Headset showing us that data. Morgan, anything else that you want to add to 2021? What is your crystal ball prediction? Anything that I didn't include on this list that you kind of see coming through, or that you are interested in investing in this year?
Well, we touched on hemp early, industrial hemp specifically. think that's great that that's at the top of the list, because that's an area that does need a tremendous amount of capital flow to build out the needed infrastructure there, and a lot of time and development. So that's great to see. International expansion, we didn't really touch on yet. And I think there's, we're very select, as we have noted here in the US, and same thing with international. We've spent a lot of time researching these markets. Before COVID, we were traveling a lot, and we were traveling a lot overseas, and just trying to get a sense and network really across the world, so we keep a pulse on these areas. But an area we invested in was almost 2 years ago now, in Mexico. We saw that coming together and saw that to be a very promising market, and here we are. Now that it's a federally legal medical market. So the United States is now sandwiched between two federally legal markets. And Mexico will be multiple times the size of Canada at its run rate. We got a ways to go, and it's just, again, here we are at the front end of the curve, and think that it's great to see that market coming together after a little bit of delay. Obviously, COVID slowed some development, but we're back in action, and we're so happy for the people of Mexico. We think this could be such a benefit to their country, and opening up new investment opportunity there is really interesting. And so that, from an international perspective, is one we're most optimistic about, and see a lot of promise there. And it's just going to have to be thoughtful and take your time. We do see capital in this space does tend to get very undisciplined when things are going well. Everyone's a genius in a bull market, and we're certainly seeing a lot of prognosticators coming out of the woodwork, thinking they know everything about cannabis, and that's why prices get distorted and capital gets misallocated, and just things happen negatively. But if you stay disciplined, there's some really interesting opportunities, and I think Mexico is from an international perspective is right there.
Well, yeah, and I think, just Josh, to tie to your chart on I think it was number 5, cannabinoids was, you have a Confident Cannabis mug. Love that company.
All right.
Yeah, look at that. Number 4, cannabinoids. To dovetail to Morgan's point, that is going to be specifically very interesting for that international market play, because it's not going to necessarily, at least initially in the medical side, it will be much more about the specific compounds of the plant in different formulations that they can get into the market from more of like a pharmaceutical standpoint. And then, of course, when adult use opens up, you'll see more whole plant experience like we have in our adult use market here in the US. But I think the cannabinoids, and not just CBD, but all of the active compounds and terpenes that will really drive different effects are what we're seeing IP being developed around in that landscape. So more to come there.
So with Mexico potentially going legal, you also have Israel, again, like you mentioned, Morgan, creating that sandwich of FOMO and speculation. What is that going to do to exit strategies? Do you think it's going to increase the amount that are filing an IPO? Because I want to talk about the speculation and the crazy stuff in the market with AMC and GameStop, and how that's going to impact the cannabis markets that are publicly traded. But from a legalization standpoint, any crystal ball, any insight to that?
There certainly is a lot of interest internationally. We just think it's ahead of the TAM, right? The total addressable market. Israel has been a leader in research, right, and in development, and so that's where you always look for research, and what's coming is that country has been fantastic there. But it's a small market from an investment perspective. So there's always two things, or not just two things, but there's one thing where it can be really interesting and impactful. Doesn't necessarily mean it's an investment perspective, opportunity. And those two can deviate. They can obviously come together, and so that's kind of where we look there, and certainly look at a lot of opportunities there, but haven't invested there yet, because it just hasn't felt like the intersection of the IP creation and the return on investment. Just haven't aligned yet. We always are looking though, because things change constantly, and so we're just always eyes open and keeping an eye out there. Yeah, I don't know if I have too much there, other than I know you want to touch on the GameStopification Redditor impact.
I do. The gamification of trading, where a bunch of individuals can take down a hedge fund and force them to grab $1.5 billion just to keep their short play. I know there's a lot of people that don't understand the markets and they don't really agree with shorting. Whether you naked short 140%, you think that's moral or ethical or honest, is an entirely different subject matter, because it is legal, whether that's fortunate or not. Do you have any opinions about what's happening with AMC and GameStop and Wall Street bets, and how that may impact cannabis stocks?
I mean, I'll just say that, and I always just get for by the way, good for retail investors for like digging in and trying to like create some equity and access to trading and creating wealth. I think what we're seeing here is that people inherently feel like they don't have access to take their wealth up exponentially like the people do who are in a certain bracket above accredited investor. And so I think that they're, good for people for trying to take that into their own hands. I struggle because I'm always like a stickler about let's push capital into companies that are building. Let's push capital into companies that have like a long run trajectory that are going to be doing stuff. So I struggle with, the particular names that were selected to play this. I mean, it was a game. It's a game. And so that's also kind of a frustration for me, is that I don't view investing as a game. I view it as a real strategic and thoughtful decision process, and it's all about building things for us. But that's where we sit. That's our role in our investment landscape. I think that we could certainly see this, and I think we already have started. I mean, one of the kind of lower quality cannabis names was lumped into that whole thing. I don't know if you saw that the other day, but it was in the ticker like basket that was getting played with the other day. So it's there, but I think there are limitations to that kind of thing happening, because we are like our companies are not traded. Many of them are not traded on the exchanges. And so there's just not the access to it. Morgan is way savvier on this, so I'm going to pass the ball to him. But it's just it's a technical limitation, I think, to some of the things that we saw play out with GameStop and AMC as it exists today. But Morgan, what do you think?
Yeah, I think you nailed it there with GameStop. I mean, the retail crowd did a phenomenal job. They uncovered an opportunity where everybody had gotten lazy, I would call it. I mean, lazy with risk management, lazy from a regulatory perspective, and they nailed it. And good for them for just totally opening the eyes of structural missteps or just, again, laziness, because they ran it hard. So good for them. But the problem with that is then they think, well, we did it here. Where else can we do this? And the derivative of that, like I'm looking at a ticker today of a stock that the common is effectively worthless, and the stock is up probably over 100% in the last 2 days because they think they can do the same thing here, where they're not sticking it to the man. They're actually making a very select group of people very wealthy, and they're going to be stuck holding the bag because the common is worthless or effectively worthless. And so that's where this it goes from a trade of probably a lifetime to then potentially losing it all by handing it back. And that's where the problem becomes, where it becomes sad. And that's what we just don't like. To Emily's point, we're builders. We don't like to see capital being destructed, and there is certainly a casino-like mindset to the markets right now, and this revenge, which we get. I mean, there's been some structural barriers that have certainly benefited wealthy people at the expense of who are considered retail or dumb money, and they've proven that we're not dumb. But the problem is, if they don't keep discipline, the larger groups, they're learning, and they're already going to start to exploit these potential trades. And that's why I said, like, it was a fantastic trade what they did. And I remember I was hearing about it in the summer, and about the GameStop setup, and I was like, I thought it was a phenomenal idea. but we invest in cannabis. It's not something we do, but I was like, yeah, they're onto something here. And but anyway, yeah, the longer term implications do concern us. And nice thing about cannabis, outside of some of these select names that Emily mentioned, the one that was initially caught up in that, they've raised a ton of money off of this. They've benefited. They bailed them out. And again, that's going to come at the retail investors' expense. They just got diluted like crazy. If they didn't get out, they're going to get washed out. And like the one I'm looking at right now, same thing. Like they're going to get hammered if they're not out in time. And
the hold on for dear life crowd doesn't understand that there's not that there's a finite number. They think, like crypto, that there's a certain number of Bitcoins, whereas number of outstanding shares can just keep being issued technically,
Right.
And so I don't think they really understand the valuations.
Yeah.
It's a little scary. And I think there's some commonality between, if we can make a comparison with the CBD industry and some snake oil with a lot of the stock market. Where is the trust factor? If people are going to try and invest in things that aren't pump and dump, that aren't penny stocks, that are legitimate cannabis companies, are they going to invest themselves, or are they going to have to utilize technology like artificial intelligence to allow those trading platforms to trade for them? I don't know. I guess it's a trust factor. Is this going to deteriorate the entire? Because there is no fundamentals. Let's be honest about that. No. People have been trading off technicals for a long time. So where do you get your information to trade? I don't know. Maybe that's a podcast for another day.
Yeah, that's roll up your sleeves and dig in. But, and it's like Morgan and I always talk about this quote from Buffett, which is, in the short term, the market's a voting machine. In the long term, it's a weighing machine. And, I think that's kind of how, we like to think about it. You can play in that kind of voting movement and do it for a little bit, but you have to get out before it goes against you. But we like to, build things that in the long run, the weighing machine really proves that they're value drivers in society. And that whole notion of, if you build something good, the returns will be good from it.
There is a lot of advantages to have private companies, like you guys have mentioned in the podcast just today, about not having to worry about the quarter to quarter investors and the numbers behind it, and just allowing for that organic and natural growth to happen without a lot of forced numbers to appease people who aren't really into or truly invested in the company. They're just looking for a monetary return.
Yeah. Price and fundamental rarely intersect in the public markets. It's usually just for moments in time. But fundamentals on the private side, it's a much different market. And that's a challenge for companies that do look to exit, is if you're on the wrong side of that timing, you could be penalized, or it could be fantastic. And, certainly everyone seems very smart for going public right now because the markets are fantastic. But, it's amazing how quickly memories fade.
That's the longest bull run in history. Like, you couldn't go wrong.
Right. But in cannabis, we went through an 82% drawdown. That wasn't that long ago. That ended last March, not even a year ago. And, so we're off those lows nicely, but that was an incredibly challenging period of time. That capital recession was brutal. It caused a lot of, what we call the Darwin phase. But that was a natural, necessary force that got companies in a good position. And those that made it through, are why we're talking about all the other things we're talking about today, because they managed through that. They stayed disciplined, or they, made good decisions that kept them in the game through a very challenging period of time. And so, there is a bit of, rightfully rewarding them with some multiple expansion. But again, I feel like price and fundamentals have, once you're public, it's just momentary, and who knows where we'll go from here. Is it Matt McGinley is a Needham analyst. He does some fantastic reports.
He's really good.
He did one analysis comparing cannabis to other highly regulated industries like alcohol and tobacco, looking at profit margins and EBITDA margins. And here we are trading similarly to them, but we're growing. These companies are growing 50, 100% versus them low single digits. So, as the federal legalization risk declines, meaning that there's, visibility towards that, then arguably on a relative valuation perspective, we should be trading at a premium. So when people are like, oh, the markets have gotten out of control, don't forget that the stock market is a market of stocks, and looking at the individual companies tells a vastly different story than just a brushstroke.
That's a beautiful way to wrap that all up. Is there anything I missed? Anything else you guys want to cover before we wrap up this podcast?
No, thank you for having us on.
Yeah, I appreciate it. Where can people... Whoa. Sorry about that. Where can people find you at?
We're at Poseidon.partners is our website. You can follow us at Poseidon Asset on Twitter. We're pretty active on there. We kind of dropped Facebook. I'm not into it. Morgan, what's our LinkedIn? Is it at Poseidon Asset? I can never remember that. Find us on LinkedIn.
Yeah, we'll have all those links in the show notes anyways. Facebook is a black hole for me too. It's kind of a nasty little platform there. So we'll have all your social media and links in there. Go ahead.
Yeah, and you can also find, if you follow me on Medium, we post a lot of content from Poseidon on there as well. We're writing more and more about valuation, structuring, a lot of things that we think a lot about. So
perfect. All right, I want to thank my guests, Emily Morgan Paxhia, co-founders of Poseidon Asset Management. Appreciate you guys being on the podcast.
Thank you, Josh.
Thank you. I'm Josh Kincaid. This is The Talking Hedge. Don't forget to like, share, and subscribe, or don't. And I'm out. Don't forget to smash that like button on your way out and check out these other videos that we've got.